Just when the market started breathing easier, boom. A geopolitical lightning strike flips the entire narrative. Oil soars, gold breaks records, and risk appetite crushed. The week ending June 13th began with a string of disinflation signals. Soft CPI, easing producer prices, and even a rebound in consumer sentiment. Perfect setup for the Fed, right? Until Friday, when a sudden escalation in the Middle East sparked a global dash for safety. Stocks dipped, bonds rallied, and now, everything hinges on one thing. Wednesday, June 18th, the FOMC. This podcast unpacks what just happened and why Powell's next move could reshape the rest of 2025. Stay with us. Get the edge before the markets make their next move.
This week, well, we're diving into a market that completely flipped the script on us.
It really did, just when things seemed to be settling down.
Exactly. That sort of data-driven calm just vanished, replaced by this big surge of risk aversion driven by geopolitics. We're going to break down what happened this past week, ending June 13th, and maybe more importantly, what it means for the week ahead.
Yeah, it was a week that really underscored how fragile these market narratives can be. We have these strong signals of inflation easing,
right?
Which is exactly what central banks, especially the Fed, wanted to see. But then, bang, this geopolitical shock just throws a wrench in the works right before some really crucial decisions.
It felt like a lightning strike, didn't it? So here's the plan for you. We'll go region by region, US, Europe, UK, Japan, China, see how they reacted. Then we'll preview next week, which is absolutely packed.
Seriously packed.
And finally, we'll zero in on the top 5 macro risks you really need to keep an eye on right now. Okay, let's get into it. Starting with the U.S. markets, where that calm we mentioned, well, it really shattered late Friday. The main indices finished in the red.
Yep.
S&P 500 down 0.39%, NASDAQ lost 0.63%, and the Dow Jones took a bigger hit, down 1.32%. Wiped out the week's earlier gains.
And what's interesting there is how the week started. We got some genuinely soft inflation numbers.
Yeah.
CPI rose just 0.1% month over month in May.
Tiny.
And core CPI, stripping out food and energy, that held steady at 2.8% year over year. Even the PPI, the producer prices, came in lighter than expected. These were all pointing towards disinflation.
Yeah, good signs for the Fed, you'd think. And not just that, consumer sentiment looked like it was finally turning a corner.
Right, that Michigan number.
Yeah, the University of Michigan index jumped quite a bit from 52.2 to 60.5. That broke a 6-month losing streak. It felt like maybe, just maybe, that soft landing wasn't totally off the table.
And all of that was feeding into what people expected from the Fed, the FOMC. Coming into the week, their stance, especially Powell's, was very data-dependent. The dot plots, their projections, they still suggested maybe 1 to 3 cuts sometime in 2025. They held rates steady at 4.5%, basically waiting.
Waiting for the data we just talked about?
Yeah.
But then Friday happened. News broke about the Israeli airstrikes on Iran.
And the market reaction was immediate. Textbook risk off. Oil prices surged. WTI jumped around 7%, pushed close to $73 a barrel.
Wow.
Gold, the classic safe haven, shot up to a new record, $3,450 an ounce, and bonds. Yields dropped as money piled into treasuries. The 30-year yield fell to 4.84%. People were just seeking safety.
So let's put it together for the U.S. You had this picture building. Good inflation data, maybe giving the Fed room to breathe, maybe even cut sooner.
Right.
Then, boom, this energy price shock just days before their big meeting on June 18th. How does the Fed look at that now? Does the oil spike negate the good inflation news?
That's the million-dollar question.
Yeah.
It completely complicates their decision. They got the disinflation signal they wanted, but now there's this potential resurgence of energy inflation. It really shows how one event can just shift everything.
And why this matters to you. The Fed's decision hits borrowing, costs mortgages, loans, everything. It affects the whole economic outlook.
Absolutely critical.
Okay, let's hop across the Atlantic to the Eurozone. We saw some really worrying signs there, sparking fresh fears about stagflation, that awful mix of weak growth and high inflation.
Yeah, the indices took a hit. STOXX 600 down over 1.5%. Germany's DAX tumbled more than 3%. France's CAC 40 fell about 1.5%.
Ouch.
And the data underpinning that was, frankly, pretty grim. Industrial output in April fell 2.4% month over month. That was way worse than forecasts.
Okay.
And maybe even more worrying, the Eurozone's trade surplus just collapsed. It shrank from over $37 billion down to under $10 billion. That points to weakening demand, both at home and abroad.
So demand's weakening. What's the ECB, the European Central Bank, saying? Lagarde sticking to the script that policy is well calibrated, right?
Pretty much, which the market is reading as, okay, we're probably pausing rate cuts for a while. Yeah. Maybe 1 or 2 more cuts, max, for 2025.
So they're pausing just as demand weakens.
Well, that's the bind they're in. Demand is weakening, but inflation, while lower, is still sticky. And now you throw in the risk of energy prices flaring up again because of geopolitics, right when they're hitting pause. The timing is just really difficult.
So the takeaway for the Eurozone, stuck between weak demand and sticky, possibly rising inflation, that ECB pause looks pretty shaky now. And for you, this really highlights that tough balancing act for policymakers. It affects confidence, investment, the whole regional outlook.
A very tricky spot.
All right, we hop over the channel to the UK. Bit more of a mixed picture there. We saw consumer resilience, but also some signs the underlying economy is fragile. The FTSE 100 was pretty stable, actually, down just 0.05%.
Yeah, that stability kind of masks the contrasting data points. On the plus side, retail sales for May beat expectations, up 1.2% month-on-month and over 5% year-on-year if you exclude fuel.
So people are still spending.
Seems like it. The consumer's holding up.
Yeah.
But then you got the GDP number for April, which contracted 0.3% month-over-month. That was the worst since last October. So weakness underneath.
And the job market.
Showing some cracks, too. Unemployment ticked up to 4.6%, and wage growth slowed a bit to 5.2%. Still high, but easing.
So the Bank of England, they held rates at 4.25% last time, but there were dissenters, right?
Exactly. 2 members actually voted for a cut. So the debate is definitely live within the bukey.
So boiling it down for the UK, looks like consumer spending is the main thing holding the economy up right now. But with growth weak and the labor market softening, the pressure's building on the Bank of England to eventually cut rates.
That's the narrative.
And why this matters to you, especially if you're in the UK, your spending is crucial right now. But can that last if jobs get weaker and wage growth keeps slowing? That's the big question.
It's a real tussle for the Bowie. How long can they hold off cutting if the economy's clearly struggling in places?
Okay, let's head over to Asia now. Starting with Japan, the Nikkei 225 actually managed a small gain, up 0.25% for the week, while the broader 2-Penex index dipped slightly, 0.46%.
And the Bank of Japan, the BOJ, they stuck to their guns, kept policy super loose, rates steady at 0.5%. They're clearly still focused on supporting the economy.
But inflation is still an issue there, isn't it?
It is. Core inflation is running at 3.5% year over year. That's pretty persistent pressure.
And what about growth? There was a GDP revision.
A minor one. Q1 GDP was revised up slightly from a small contraction to basically flat 0.0% growth quarter on quarter. But the yen weakened late in the week.
Because of the risk-off move.
Exactly. Global risk aversion pushed the dollar higher against the yen towards 143. That's not helpful for Japan's exporters.
So the takeaway for Japan. The BOJ is trying to be patient, keep policy easy, but that sticky inflation and a stronger yen are making life more difficult for them, sort of tightening their options.
Definitely less room to maneuver. And why this matters. Japan's monetary policy is a big global factor. What the BOJ does, or is forced to do, has ripple effects everywhere.
Okay, last up on our world tour, China. Shanghai Composite, CSI 300, both down about 0.25%. Hong Kong's Hang Seng managed a small gain, 0.42%.
And the big story in China, well, it hasn't changed much. It's still deflation. Deep deflation.
So?
Oh, yeah. Consumer prices, CPI, negative year over year for the 4th month in a row in May. And producer prices, PPI. That's down for 32 straight months now.
32 months? Wow, that's serious.
It shows a real lack of demand, overcapacity issues. Everyone's just waiting for significant stimulus from Beijing. There was some hope after those U.S.-China tariff talks, but the market wants to see real action.
So the key takeaway for China, stuck in deflation, and everyone's watching Monday's data like a hawk. Industrial production, retail sales.
Exactly. That data dump on Monday is crucial. Will it show any signs of life or just deepen the concerns? And why this matters globally. China's huge. Its struggles hit global demand, commodity prices, countries that trade with it, everything.
Okay, wow, what a week that was.
Yeah.
And now, let's brace ourselves for the week ahead. June 16th to the 20th, it looks absolutely loaded.
It really is. After the week we just had, this next one could easily amplify the volatility.
Yeah.
The main event, no question, is the FOMC meeting midweek.
That's the headliner. But let's quickly run through some other key things you need to watch based on the upcoming schedule. In the U.S., Tuesday, we get May retail sales. That's key for the consumer picture.
Yep.
Wednesday is the big one. Housing starts and permits for May and the FOMC rate decision, followed by Powell's press conference. That's huge. Thursday is Juneteenth. U.S. markets closed, but we might still get Fed speak. Then Friday, Philly Fed index and jobless claims.
Over in the Eurozone, Wednesday brings the final May CPI reading. Get the final inflation number there. Then Thursday, crucial speeches from ECB President Lagarde and VP Guindos. We'll be listening closely to their tone.
In the UK, Friday's the day to watch. GfK consumer confidence for June, and May retail sales excluding fuel. We'll see if that consumer resilience is holding up.
Japan has its own big central bank meeting. The budget rate decision is on Wednesday. We also get trade data. Then Friday, May CPI figures come out. More fuel for their inflation debate.
And China kicks the whole week off early Monday with that massive data release. Industrial production, retail sales, fixed asset investment, unemployment rate, those numbers will set the tone right out of the gate.
So yeah, potential market movers literally every single day next week across different regions. No time to relax.
Okay, so pulling all this together, based on everything we've just discussed, there seem to be 5 key macro risks really standing out right now. These are the fault lines, the things that could really shake things up this week.
Absolutely. These are the ones to watch. First, obviously, number one, the FOMC decision on June 18th. The big question is about Powell's message. After that oil spike, will they sound more cautious, maybe walk back some of the optimism from the softer inflation data? How do they thread that needle?
Okay, number 2.
Middle East tensions. If things escalate further after Friday's events, you could see oil prices get even more volatile.
Yeah.
That would force everyone to rethink inflation risk globally.
Right. Makes sense. Number 3.
The China macro pulse, specifically Monday's data, June 16th. Those industrial production and retail sales numbers are huge. They'll tell us if China's deflation problem is getting better or worse, and that immediately impacts emerging markets and commodities.
Number 4.
ECB messaging later in the week, Thursday the 19th. Those speeches from Lagarde and Guindos, are they just pausing rate cuts tactically? Or is this signaling a much longer halt, especially with weak data, but potential inflation risks? We need clarity there.
And the 5th risk.
UK consumer data on Friday, June 20th. Given that mixed picture, strong sales, but weak GDP, the GfK confidence in the latest retail sales figures are really important. They'll shape expectations for when, or maybe even if, the Bank of England feels it can start cutting rates.
Got it. So those 5. FOMC messaging, Middle East risk, China's data pulse, ECB signals, and UK consumer health. Those are the hot spots.
Exactly. Looking back at the week and forward to the next one, it feels like the whole macro narrative has shifted, doesn't it? We started the week thinking about, soft landing, maybe some easing.
Yeah, cautiously optimistic, maybe.
And we're ending it and heading into next week with a narrative dominated by caution and geopolitical uncertainty. It's a big shift.
It really is. And with that Fed decision and Powell's press conference right in the middle of it all next week, Wednesday looks like it could be a defining moment for markets, setting the tone for the whole second half of 2025.
I think that's right. The final thought really is, expect volatility. Things just got a lot less predictable. And watch Powell's language very, very carefully on Wednesday. Not just the decision, but how he explains it. That's what will guide global markets, which really raises the question for you. How do you navigate this shift? How does this change your view?
A lot to think about. That wraps up this deep dive into a really pivotal week for global markets and what looks like an even bigger one ahead. Thanks for joining us as we navigated through all this data and these events. We hope this helps you make sense of the shifts.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format. AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.